By tomorrow, New Zealand will officially be in a recession with quarterly growth figures expected to tank. But the Finance Minister is looking on the bright side, saying the economy is doing better than expected after the government threw open the books ahead of the election. The Treasury update shows the economy didn't take as big a hit as expected from the lockdowns, but the picture for the medium term is more gloomy than initially predicted, due mainly to international uncertainty. It's forecasting unemployment will almost double, the borders will remain closed until January 2022, and debt will hit 55% of GDP by 2024, up from 19% last year. So what does this soup of numbers mean? Well, Kiwibank's chief economist, Jarrod Kerr, joins me this evening. Hi, Jarrod.
Hi, how are you?
Very well, thank you. The government's headline in their press release was "Economy doing better than forecast." What's your headline?
Nothing's changed, basically, from what we've been seeing in the last few months. When we're in the middle of the lockdown, we thought that the economic damage that was going to be inflicted would be much worse. We came out of lockdown earlier and we have been surprised, really surprised how spending has bounced back, how the housing market has bounced back. But look, it's a long road ahead. I believe the Treasury's forecasts in the budget earlier this year were rather heroic over the medium term, and they've been revised down to something that looks a little bit more reasonable, and it's going to take us a long time to recover.
So what does that look like? Because basically we are being told that the initial shock was less severe, but it's going to hang around for a bit longer. So what does that mean?
Well, the first thing you think about is how long are our borders going to be closed for? When we were in the original lockdown, we thought, geez, I don't know, maybe a year. So we'd sort of guesstimated around the middle of next year. Now it looks like our borders are going to remain closed well into 2022, possibly 2023. That's a massive change in assumption in itself. The global outlook is also weaker, so our trading partner growth is lower. We're probably going to get lower commodity prices, and just not having international tourism for years it hurts the small open economy.
So that forecast, pushing out even potentially to 2023, do you think that's a fair one in terms of the borders being closed?
Unfortunately, yes. I mean, until we learn to live with the virus and until we're comfortable in allowing foreigners to come in, the borders are going to remain closed. I don't think there's much debate around that. I hope we get to a point where we can say, hey, look, let's let tourists in, let's let long-term workers in, let's open up a little bit. Anyone who's willing to come here and go into managed isolation for a few weeks. But, it's going to be hard to attract tourists who want to come down here and spend 4 weeks on holiday, but the first 2 weeks is in a cage somewhere.
So unemployment, okay, so that's heading, almost to 8%, which would be pretty much double from where we were, 4%. So what's that, about an extra 100,000 people? Why is that figure going to stay higher for quite a while?
It's the economic scarring. It's the fact that we're losing people in tourism-related industries, and then we're going to have to try and absorb them elsewhere. And I think it just takes a lot of time for people to pivot into new industries and find new jobs. But also we're in a position where we really need to start cranking up and creating new jobs to absorb these people.
So what, cutting down wilding pines and shooting wallabies, not enough?
I reckon that would be a great start for sure, but there's a lot more that can be done. I mean, we're talking a lot about infrastructure, very male-dominated industry, but we need to fire up and think about how we can get more workers into health and education and other areas which I think have been neglected for decades.
So for some people, the scary figures are the debt, right? 55% and then some small change of GDP by 2024. First off, in real cash monies, how much is that?
So the total amount of government debt on issue was around 70 billion before the COVID crisis, and it's going to increase to about 210. So that's a pretty big increase. But we're starting off with net debt being around 20%. Going up to around 55, as you say. For New Zealand, that's a big move. But for internationally, most countries, just about all developed countries around the world, would love to start at 55%. They're all going to end up well over 100%. So at the end of this, we're still relatively well off and fiscally responsible compared to most countries in the world. The game here is to get the economy up and running and making the economy more resilient, more productive in the future so that it can handle that extra debt. So it's more about getting these projects done, making the economy faster and bigger, so that debt in nominal terms today actually starts evaporating as GDP cranks up in the future.
Yeah, so as a proportion of our gains, it becomes a smaller number. But what is realistic in terms of getting that back to around the 30% mark? Because we have one of the parties, National, suggesting that they could be on track to 30% by 2030. Is that realistic? What number would be if it's not?
Yeah, I'm glad you said 30% because I think 20% was always too low. I actually thought that was a bit irresponsible. We'd been underinvesting in our country. 30% sounds about fair, and look, sure, if we can grow at a decent clip of around 2 to 3%, then 30% is achievable by that 2030 and beyond. And I think that's a good objective.
Okay, so when we get the figures tomorrow, what are your expectations?
Oh, look, it's going to be a big decline. We think it's going to be around 12% on the quarter, which is a staggering figure. I think the stats department, was having all sorts of problems actually measuring the number in such a difficult quarter. What's interesting will be how we bounce back in the third quarter. We're picking a sort of a 10% bounce back, so we've seen some wild fluctuations in the data. Once we've gone through this rough patch, it's how we grow back into 2023, and that's the slow and difficult path to get our economy back to the size that it was at the end of 2019.
I'm just curious, given how we're tracking with debt, and both of the main parties have always said we need to be insulated against a crisis, prepared if something happens, what kind of position would we be in if there was another economic shock, like, not wishing it, but like an earthquake? Are we in a position to handle that?
Yes, absolutely. Even if we issued all that extra debt in the next few months and we had 55% of GDP, we might get downgraded if we then had to ramp up again and go to sort of, 70-odd%. But to be honest, we're in a world where most countries have been downgraded in the post-financial crisis. So we do still have ample ability to ramp up to an event like that.
Hey, I'm not wanting to undercut our entire conversation, Jarrod, but given everybody says 1 in 100 event, nobody saw this coming, it's a world of uncertainty, can we put any stock in the forecast that we're looking at?
Not a lot, which is why we economists deal in scenarios. So we say this is what our central scenario is, but by the way, there's some chance that there's a better outcome, and there's probably more chance that there's a worse outcome. And even Treasury today gave us 3 scenarios: 1, a better scenario, and 2 downside scenarios. So that gives you the idea of where they see the risks, and it's to the downside.
Really appreciate your time this evening. That's Kiwibank's Chief Economist, Jarrod Kerr.